Welcome to the fascinating universe of investments. Today, we'll delve into the precious lessons of Peter Lynch, the renowned financial guru. Discover how he challenges the idea of natural-born investors and unveils strategies to avoid traps and maximize your gains. In a revealing personal example, Lynch shares the cost of selling winners too early. But the big twist comes in Lesson 4, where he demystifies macroeconomics, focusing on the micro. Intriguing, isn't it? Don't miss out. Watch until the end, subscribe to the channel for more insights, and unlock the code to invest wisely. Peter Lynch, How to Invest for Beginners, your journey begins now. Lesson 0, There are no natural-born investors. Peter Lynch, a renowned investor, emphasizes the pivotal Lesson 0 in his teachings on investments, the non-existence of natural-born investors. Lynch points out that success in the financial market is not inherent to a specific background or family inheritance. His own unconventional path, marked by a background in history, psychology, and philosophy, challenges the idea that only professionals with degrees in finance or mathematics can thrive. Thus, Lynch reinforces the message that investment is an art accessible to everyone, regardless of origin or academic background. In Lesson 1, Lynch instructs investors to know their advantage. He highlights the uniqueness of the individual investor's position, capable of focusing on stocks that escape the attention of large financial institutions. Lynch's practical advice involves directing attention to smaller companies that may be undervalued or underestimated by the market. By using resources like stock screens, investors can identify opportunities that escape Wall Street's radar, creating a fundamental strategic advantage. Lesson 2 emphasizes the importance of knowing which stocks to avoid. Lynch categorizes 3 types of problematic stocks: those promoted as the next big innovation, companies involved in unnecessary diversification, and those dependent on a limited number of customers. Investors are warned about the risks associated with these scenarios, emphasizing that avoiding wrong choices can be as crucial as making the right ones. By following these principles, Lynch provides a compass to guide investors in building strong and enduring portfolios. Lesson 1, Know Your Advantage. In the realm of investment guidance, Lesson 1 proclaims the imperative need for individual investors to know their distinctive advantage. Peter Lynch, an icon in the world of investments, emphasizes that this advantage lies in the ability to focus on stocks that escape the attention of large financial institutions. His guidance directs investors to explore opportunities in smaller companies, which often operate behind the scenes of Wall Street's attention. The use of tools such as stock screens emerges as a strategic resource, allowing for the careful identification of assets that can not only offer growth potential but also represent true financial gems not yet properly valued by the market. Within the context of Lesson 1, Lynch not only outlines the importance of finding undervalued opportunities, but also emphasizes the uniqueness of the individual investor in the competitive landscape. By emphasizing the ability to break away from limitations and focus on often overlooked niches, the investor takes on an active role in defining their own path. Lynch, through this lesson, instigates a proactive approach in the search for investments, highlighting the investor's ability to uncover financial pearls that may go unnoticed by the broader eyes of traditional financial institutions. Furthermore, Lesson 1 propels the understanding that the stock market is a vast ecosystem where individual investors have the opportunity to exercise their discernment more agilely and flexibly. By invoking the image of smaller companies flying under Wall Street's radar, Lynch suggests that the investor, by adopting a more thorough approach, can unearth investment opportunities that escape massive attention, leveraging the inherent advantage of autonomy and agility in the individual investor in the financial market. Lesson 2, Know Which Stocks to Avoid. Lesson 2 from Peter Lynch emerges as a guiding light of wisdom in the universe of investments, offering meticulous guidance on which paths to avoid. The financial guru warns against undue enthusiasm for stocks promoted as the next big innovation. Lynch contends that such stocks are often prematurely inflated in value, representing unstable ground for investors. Additionally, he discourages allocating resources to companies venturing into unnecessary diversifications, pondering the risks associated with scattered business strategies and, at times, lacking a cohesive purpose. In the same vein, Lynch urges investors to exercise caution in the face of businesses heavily dependent on a restricted number of customers. This warning echoes the importance of a diversified customer base for the financial resilience of companies. He highlights how these entities, by overly relying on a small group of customers, become vulnerable to sudden changes in business relationships, posing significant risks to investors. Thus, Lesson 2 outlines, in an incisive manner, a strategic map for investors, offering refined criteria to discern between solid opportunities and potential traps, nurturing a prudent and discerning approach in financial markets. Lesson 3. Lesson 3 proposed by Peter Lynch focuses on a recurrent trap in investment circles, the tendency to prematurely divest stocks showing promising performance. Lynch illustrates this behavior as the act of watering the weeds and cutting the flowers, outlining the action of depriving the portfolio of high-yield assets before they reach their full potential. The investor is warned about the dangers associated with underestimating the potential for continuous growth, a phenomenon that Lynch not only identifies but also shares an illustrative personal example. Lynch's account of his decision to sell Apple stocks prematurely serves as a tangible narrative of the inherent risks of impatience in the world of investments. By highlighting that the value of Apple stocks continued to thrive after his initial sale, Lynch underscores the importance of resisting the urge to limit gains, a practice often motivated by the fear of losing what has already been gained. Lesson 3 transcends purely financial scope, introducing psychological influence into the investor's decision-making process, emphasizing the need to overcome loss aversion to cultivate significant returns over time. At the core of this lesson is the understanding that investment demands not only a sharp vision of market opportunities, but also psychological discipline to resist emotional impulses that can compromise the solidity of the portfolio. Lynch, by sharing his personal experience, establishes a connection between investment principles and nuances of human behavior, highlighting that the pursuit of substantial returns requires not only insightful analysis but also the perseverance necessary to allow investments to fully flourish. Lesson 4. Lesson 4 uttered by Peter Lynch acts as a guiding beacon in the vast ocean of investments, discouraging the temptation to get lost in uncertain macroeconomic predictions. Instead, he vehemently advocates focusing on microeconomics, delving into the meticulous study of specific companies and sectors. Lynch argues that focusing on the micro, as opposed to the macro, not only provides a more precise and tangible understanding but also grants a strategic advantage to the investor seeking to explore the intrinsic nuances of certain familiar segments. By emphasizing the inherent unpredictability of macroeconomic forecasts, Lynch urges investors to question the practical utility of these global projections. He highlights that, often, even the most respected economists err in their macroeconomic predictions, emphasizing the difficulty of anticipating the broad behavior of the economy. In contrast, by directing attention to microeconomics, the investor is empowered to analyze more tangible and specific factors, such as the financial viability of individual companies and sector dynamics, where information is more palpable, and projections tend to be more reliable. Lesson 4 not only warns about the challenges associated with macroeconomic forecasting, but also sheds light on the investor's ability to shape their strategies around specific and detailed knowledge. By delving into microeconomics, the investor not only moves away from the volatility of global projections, but also positions themselves to discern concrete opportunities and mitigate risks more effectively. Lynch, by outlining this imperative, emphasizes that the true fertile ground for the investor is in the intricacies of the economic microcosm, where deep understanding and familiarity confer a valuable competitive advantage. As we conclude this immersion into Peter Lynch's brilliant lessons on investments, I invite you to embark on this journey toward financial prosperity. Remember, investment is more art than science, and Lynch has shown us that everyone can tread this path with mastery. If these strategies resonated with you, leave a like and share your thoughts in the comments. And don't forget, subscribe to the channel to receive more financial wisdom directly from great minds like Peter Lynch. The revolution in your investments is just beginning. Until next time, may your portfolios thrive.